What's your assessment of developments in the Middle East and ultimately what it means for you and the committee?
Yeah, I mean, I guess it's exactly the thing is what you're going to see is you're going to see a spike in gasoline prices. That's what the American citizens are going to see when they go to the pump, and they're going to stare at it and be a little shocked in terms of how things go. But for us, thinking about policy going forward, this is unlikely to cause sustained inflation. This is one reason we don't look at energy prices when we look at core. Core is a better predictor of future inflation. You're going to see this, but once these kind of supply chain issues that you laid out, Lisa, once they unravel, this will start coming back down. So it's kind of very odd to think about the Fed maybe changing rates 6 months from now based on this. If it's unwound in like as you said, Jonathan, in a couple of weeks or even 2 months, it's not going to be a big factor down the road. So this is why we never look at energy prices. They bounce up, they come back down. It's not that it's something that we don't feel sympathy for people that that's what they have to pay when they put the gas in their cars. But for us, thinking about the longer term in terms of policy, this is something we're just going to have to kind of put off for now.
When does it become something bigger, if at all?
It becomes bigger if it becomes more permanent, because then what's going to happen, you're going to see this jump in prices. Then it'll start bleeding through to other parts of the economy. Energy is a big part. It feeds into everything else. And then somehow those energy costs get passed along like everything else. So that's what you're more worried about.
Economists on any given day, Lisa, Mike, myself, and they'll talk about the experience of the 70s and coming out of the pandemic. And they'll say things like that officials of the Federal Reserve are somewhat conditioned, scarred by some of that. Is that your experience of things? Well,
in the 70s, remember, we didn't just have one. We had massive oil shocks. If you take 73, the price of oil quadrupled overnight. It went from $4 a barrel to $12 a barrel. Or went from 3 to whatever the numbers were. And that was a shock, and it never came back down. And then there was another one. Every time you turned around, there was another oil shock. Then Iran, oil embargo in 79. So that was kind of the problem with the oil shocks. They just kept coming and coming and coming. So it's not clear this will be one shock after another after another. So that's why I'm more willing to say this is, I hate to say it, but more like a one-off event than what we saw in the 1970s.
Well, as Rosanna Dana used to say, it's always something. Because if it's not just the oil shocks, it's the whole idea now of we're going to have a whole new round of tariffs coming through the economy. And we've got this low-hire economy. How long do you think that continues? Does this just push out the time period for companies to sit on their hands, not invest because they don't know what's going to happen?
Yeah, I mean, this is one of the things I've been concerned about since last June is how weak the labor market has been. There were a lot of factors last summer that were driving this kind of low hire, low fire. It looked like maybe in January we might be turning a corner. We'll find out today whether that was, as I said last week, signal or noise. But, you know, when you're in this world in which the labor market, even with 130,000 jobs, it was really concentrated in a couple of sectors. 80% of the economy, the labor market wasn't doing anything. It was 0 to negative. So that kind of fragility wouldn't take much for some sort of a serious shock to sort of start pushing people in another direction. Whether this is that kind of shock or not, we'll start finding out.
Yeah, it's early because, of course, these are going to be January numbers. Yeah. But you've been on record as saying you'd like to cut more because you're still worried about where the labor market is. What would it take to get you to back off on that feeling? Because if we get the same sort of numbers we had in December, it still shows very narrow breadth of hiring, and it still shows some reasonably good numbers for hiring.
Yeah, even with the January report, like I said, it was all concentrated in a couple of sectors. So that was good. They were robust. We got a big number, well above everybody's estimate of break even. But the concentration didn't give me a lot of comfort that the economy as a whole was doing really well. So that's where my brain is telling me the number was good, the economy looks okay, it was above break even, but my guts are telling me it may not be that good. And that's where I'm waiting to see what today's number is. I'm almost certain it's going to get revised down, because this has been a pattern in January the last few years. Lisa?
Can we pair these two ideas? The idea of the oil shock that's creating some concerns about inflation, and then a labor market that kind of is in question, right? Is it decelerating or is it reaccelerating? How much has your reaction changed potentially to today's report, given the fact that we do see energy prices pushing on inflation? In other words, would you be less inclined to cut rates if there is strength that's demonstrated in the labor market today?
Yeah, that's kind of what I was hinting at last week, that if we get another solid jobs report, then last month, this month, looks like the labor market's turning around. A lot of the downside risk I've been worried about for 6 months is kind of going away. We're going to get a hot PCE number, given what we already have seen coming in. That's going to probably print, from everything I've seen, about a 0.4. Okay, usually that comes down again. We've had this January effect. We have some more pass-throughs of tariffs. But because the inflation's hot, it's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait.
Let's say the counterfactual. Let's say we don't get a good print. Let's say we see the weakness that you see right now when you talk to people in your district and beyond, or that you speak to in the different districts as well as beyond. How much do you think the Fed should react to this? Because it's sort of the dual mandate is in conflict
Correct.
in absolutely the wrong way.
Yeah, I mean, that's the tension we've had for the last years. I've been more worried about the labor market risk, the inflation risk. I've always believed inflation was going to come back down once tariff effects pass through. My other colleagues on the committee are much more concerned about the inflation. It's been high for 5 years. They're not seeing it coming down, and they think the labor market is all stabilized. It's all supply side. So these are the two different views that people have about thinking about policy. And I was more willing to cut rates because I was more worried about the labor market, not as worried about inflation coming down. But like I said, if the labor market continues to go weak, if this thing comes in, I mean, ADP was promising the other day. So if the labor market is good, inflation's hotter than we think, it's fine to kind of wait another meeting and kind of see. But if we get a bad number, or January's revised down to some really low number, like ADP got revised in half, the labor market's just not that good. And so the question is, why are you just sitting on your hands? So I could certainly see this meeting going other way, depending on the data this week and the CPI next week comes in.
I hate to be the one to ask this question, but what's a good report? Because at 8:30 Eastern Time, we'll all be asking that question of ourselves. What's good to you? What does good look like?
Well, I think good would be if you saw another number like January. That would be really good, because you're well above everybody's break-even estimates at that point. And that'd be 2 in a row. Looks like it's going through. We got very good numbers off the ISM manufacturing and services this week. That's another indication that maybe things are turning around. So if that's the case, I'm starting to see less downside risk. Now, on the tariff stuff, I still have a view that all the tariff risk is to the downside. I just don't see big increases in tariffs spread all over the place. If anything, they're going to come down. Estimates of this are coming down. Deals are going to potentially get made. So I don't see a lot of tariff risk going, even though there's more uncertainty, there's always the uncertainty. I don't see a lot of price pressures from what we think could happen going forward. So that's going to bring, I think that's going to bring inflation down or take pressure off. And it'll take some of the uncertainty off at some point.
Well, it becomes a question of what problem are you trying to solve and what tool are you using to do it? How would cutting rates by 25 or 50 basis points help the labor market if companies are sitting on their hands because they're still waiting for tariff news and we've got a war going on?
Yeah, I mean, we can always say, we can't do anything, just sit there. That's not my job. My job is to try to help the economy and achieve our dual mandate. And if the labor market's not looking good, then I have to make this trade-off.
But does it make a difference to the CEOs?
Well, maybe not. I mean, that's what I'm saying. We could argue about whether monetary policy has any effect in general on the labor market. There's, you go back in economics back to the 80s and 90s, there's a whole camp of people that said monetary policy is completely irrelevant for the economy. So quit wasting your time.
You're opening up a very different conversation.
Yeah, that's a whole different.
We could spend a long time on. I wanted to squeeze this in. I actually think it's one of the more important topics at the moment. We're not seeing a tightening of financial conditions, a material one, in public markets. I don't see that in stocks. I don't see that in bond yields. I'm wondering what on earth you see in private markets. Because every day there's another headline about another fund, another company struggling to meet redemptions. What is the Federal Reserve assessment of what is happening? Because that has powered this economy. Some people might say, in a bigger way than the Federal Reserve, or, for that matter, public markets have. What is going on?
Well, there's a couple things. I mean, in general, I don't see really big, widespread problems in the private credit market. What you're seeing is a couple cases of certainly fraud. Is that fraud widespread? It's hard to believe that the entire private credit market is being driven by fraud or bubble posting of collateral. So these are kind of these one-off things that get a lot of headlines, but it's not clear it's systemic. You have to kind of look at whether there are a lot of, there's different types of private credit. There's stuff that's in high yield risky junk bond stuff, and there's other stuff that's better quality in terms of what they're funding. So I don't think as a whole the private credit market is in any serious trouble, but you're going to have these things popping up here and there. But I don't think there's enough of it that's going to somehow drive down the financial markets and create any kind of financial stability problems.